Hey, Rob.
Hi, how are you?
Good to see you.
Nice to
Dave
see you.
Donner. I'm going to change my name here. There we go.
How are you this evening?
Good. Happy to be moving forward with this item. It's looking very good. Just getting some opening remarks together. Hey, Stanley.
Hi, Dave. Can you hear me?
I can. Yes, that's a great background you have.
Well, that's from the hill behind me when you go to the top.
Oh, nice. That's
Yeah,
wonderful.
it looks down at like Hawthorne Canyon and towards Fairfax.
Very cool.
Yeah.
Very cool. Good deal.
Yeah. So how many are we expecting today?
I think we got everybody. I never did hear from Forrest, but I won't be surprised if he pops in. I may have actually heard from him. Let me look at my thing. No, we had great, quick, efficient responses from almost everybody. And this, you'll hear this kind of came up. Yeah, I didn't hear from Forrest. This came up as something we wanted to get in before the holidays, so I appreciate everybody's making the time.
Yeah, well, with this new shelter in place, I don't think a lot of people are going away for the holiday.
Oh, I know. It's so sad. It's so sad. My wife's parents live in the city and they're just dying to be with my kids, but it's just not worth it. I'm looking at the infection rates just since Monday. I think Thanksgiving's hitting us hard. Even Marin is now, if we hadn't done the premature stay-at-home order, we would have been in it already because we're past that 15% threshold. So it's real, Scary stuff.
It is.
Carla, I think that was Jessica Rising. I think it was something they had booked, but it wasn't going to happen. So thank you for catching that and not getting us kicked off at 7. So, hey, Richard.
Oh, hello. How is everybody?
Good.
Hey, Richard.
Hi. Hi, Stan. Oh, Dave, did the EDC meeting end a little abruptly the other morning?
Yeah, I'm not quite sure why Jessica turned it off so quickly. I think it was, we missed a couple of items, sort of, routine items, but still, I think she was maybe caught up in the emotion of saying goodbye to John. I'm not quite sure.
Yeah.
But yeah, I was sort of shocked that it just sort of faded to black very quickly.
Right. Okay.
But,
Yeah. I didn't. Yeah. Good. Yeah. I didn't know if something was wrong with my computer or if I had just.
No. No, that threw everybody, but I think, I don't think wasn't probably worth trying to get everybody back on for those items, but it was definitely something that wasn't expected.
Oh, okay.
Yeah. So we have I think we need 4 of you. Since we have 6, we need a 50% plus 1, but we still got a couple of minutes here.
Mhm.
Oh, there's Lori. All right, we're almost there.
God, I have to open my laptop up. Almost ready. Okay.
Hey,
Hello,
Lori.
everybody. Whoops.
Thank you for making the time for this kind of last minute meeting. Oh. There's Helen.
Hello.
Hey, Ford.
Good.
Hi, Mark. How are you?
Good. How are you?
I'm doing fine. Hey, Ford.
Hey,
You're in a different spot.
yeah, I'm gonna multitask since I'm just basically an observer, so I'm in my office.
Gotcha. Okay. Thank you for coming. So let's see. We have 1, 2, 3. We're still waiting on at least one more financial advisory board member before we can get started. So I think we're still 2 minutes away from 6 o'clock. Oh, Marie. Yeah, Marie will be here. She's leading the meeting.
Was my alarm. Time for a meeting.
Hello, everybody.
Hey, Marie.
Oh,
Hey, Carla.
Hi, Marie.
Before we start, just want to make sure, like, we maybe give a couple of minutes. I didn't see any RSVP. David, I know you wanted to have at least 4 people. Do you know who is coming, or do you know who is not coming? Do we need to wait more?
The only one I didn't hear from was Forrest. We sent a couple of emails. I never heard, but I think we have our quorum now.
I think that we have a quorum here, right?
Yeah. We do.
Oh.
We have.
Okay. So let's get started. I'm sorry, I'm just running from another meeting to another one here.
Great.
Let's call the December. What dare we? The December 9 Finance Advisory Committee to order. Welcome to everybody. I hope everybody is fine, and at least the one I see are healthy, hopefully. This is really going to be a one agenda meeting today, but I do believe we need to approve the notes from the last meeting, right? They've like some notes were sent, but I was not so sure about that.
No, we'll get those at the next one. We're just going to go through
because
it.
They were sent, and I was just because there was no agenda. I was thinking, do we need to approve them or not? Okay, we don't.
Oh no, we'll get those at our next meeting. Yeah.
Okay, perfect. So it's really a one agenda meeting, and thank you everybody for joining in at the last minute for this one-time exceptional meeting. And I'm just going to pass the baton to you, Dave,
Okay,
for introducing why we are all here this evening on this special notice.
fantastic. Thank you, Marie. And once again, thank you everybody for making time sort of on relatively short notice to hold this meeting. We're here tonight to talk about specifically the Central Marin Police Authority's unfunded accrual liability, UAL. The authority has decided to move forward with a process to refinance their UAL, which is held under, as you know, under CalPERS. And as part of this, we have a kind of a unique situation in 2013 when the San Anselmo joined Twin Cities to create the Central Marin Police Authority. There was a safety-specific UAL that was for our police department here in San Anselmo. That was something that we paid on an ongoing basis. When it was agreed to merge with Central Marin, that liability went over to the authority. But for a number of reasons, it stayed on the books of the town, even though it's been being paid for the last 7 years by the Central Marin Police Authority budget. As part of the refunding, Helen and I had reached out to the other two managers as well as the team at, I hope I'm going to say it right, Wolf Hansen,
Correct.
who are with us tonight, about the possibility of San Anselmo participating with the safety UAL in the bond refinancing that's happening with the rest of the debt that sits with Central Marin. And it's very tricky. So we had to ask permission to have this presentation. Depending on the outcome of this presentation, we hope to bring it to the town council for consideration on January 12th. But we wanted to kind of get your opinion about, get the Financial Advisory Board's opinion and recommendation about this sort of transactional idea. And we're lucky enough to have the team from Wolf Hansen here tonight, and they're going to run you through a very detailed presentation, kind of outlining what this would mean for San Anselmo and for the CMPA UAL in general. So with that, Mark, you're going to lead things off?
Sure. Yeah.
So I'm going to hand it over to Mark Pressman with Wolf Hansen. Mark's been the one that we've been talking with, and we also have Rob Pancraz, and I don't know if Bud's coming or not.
Bud had an issue with it. His wife had some medical issues, so he won't be joining us.
Okay.
But typically he would be on the call. And again, that's one of the reasons that we work. We have a backup system where we have all of us. And so if something like this does happen, we still have sufficient resources to be able to make the presentation or respond to inquiries for you or council members or whoever.
Right, sure. And we're lucky to have our one of our council members, Ford Green, who's one of the liaisons to the Financial Advisory Committee. Ford's going to be in the background, but he's going to be listening. He's also soon to be what I think is the chair of the Central Marin Police Authority Board as it's San Anselmo's turn. So Ford's been involved in the town longer than anybody here. So thanks for coming, Ford.
And also, if I can provide any feedback, just because I'm muted doesn't mean I'm not listening. So call me out and I'll do my best to respond.
Perfect. Thanks, Ford. Okay, Mark, it's all yours.
Okay. As sort of housekeeping, we have been retained by Central Marin Police Authority to advise them, to provide advice to them relative to this refinancing transaction of the CMPA's UAL. We have been hired by them, so they are our client. We are not advising the town of San Anselmo directly. We're giving advice to the town of San Anselmo because you are a member of CMPA. So we're doing sort of a roundabout way, and we have to make this very clear to you because of regulatory requirements. We just don't want to go to jail, and so we have to make it very clear that as a member of CMPA, we can advise you, but we're advising you as a member of CMPA, not directly to the town of San Anselmo, okay? So with that, Rob, you want to go to the next slide? I'll turn it over to Rob and let him make the presentation. And then if anybody has a question during the presentation, please feel free to jump in. And then after it's concluded, then we'll also open it up for further back and forth conversation. So with that, Rob, you want to go?
Yeah, thank you, Mark. Good evening, everyone on the Finance Committee. I'm Rob Pankratz, and I've been with Wolf Hansen since 2017, and I will be leading the first part of our presentation tonight. Our presentation is essentially broken out into two separate sections. The first section being sort of a general overview of the CalPERS system and an overview of unfunded liabilities. What are they? How are they created? Why are they growing? And then the second section of our presentation will show a financial illustration of San Anselmo's safety police plans carved out from the general financing. So you can see what just the effect on your portion of the obligation is. And that's what we'll be covering tonight. So to jump right into it, starting with an overview of the CalPERS system. CalPERS is the California Public Pension Program. It's the largest of its kind in the United States. The town of San Anselmo, as well as the Central Marin Police Authority and most other public agencies in the county and in the state, participate in this pooled retirement system. The town or any other participating entity periodically pays into the system. The system in turn tries to earn a 7% annual investment return on the money that you give to them. 7%, their target return, is the amount of investment return that CalPERS has calculated that is needed to fund retirement benefits for member employees going forward. So jumping down to sort of the center section of this slide, normal cost CalPERS payments. Payments to CalPERS consists of two different types of payments and two different payment components. The normal cost component and a scheduled payment towards your unfunded liability. The normal cost payment is the total amount that CalPERS has calculated that is required in any given year to be deposited to complement the investment performance from that year, so that the system can pay out all of the benefits promised and cover all administrative costs. So both the normal payment and the UAL, when collected by CalPERS, are invested into these pooled retirement programs. Jumping down to the third section of this slide, CalPERS investment performance. If CalPERS does not earn their targeted 7% return in any given year, the difference between 7% and their actual investment performance creates a shortfall in funding for the system. That shortfall is charged to the individual employers or member entities, such as the town of San Anselmo and such as the Central Marin Police Authority. So that shortfall that they charge you for not hitting their target return is what's called an unfunded liability. It's also referred to as an unfunded accrued liability, UAL, or unfunded actuarial accrued liability, UAAL. And you may see it referenced as such in various CalPERS documents or in other correspondence. Is there any questions on that first slide? Seeing none, I'll move on to the next slide. So starting here at the top, unfunded accrued liability. Every year that a new UAL is created or accrued, it's added to the existing unfunded liability balance of the participating employer, such as the town. Each year that your unfunded liability balance is charged at an interest rate of 7%. that is the return that CalPERS projects that it could have earned had the funds been fully invested in the pension program. And it's the same rate that I mentioned on the previous slide that's needed to pay out projected benefits. Moving on to the second header, schedule of UAL payments. Every year, CalPERS provide each employer, such as the town, with a payment schedule so that gradually over time you can fund the unfunded portion of your pension program over a set period of years. The current schedule for the safety police plans for the town run through fiscal year 2040, 2041. So 20 years remaining of the UAL safety police obligations. Future performance, the next section. If in any given year CalPERS earns above the target return of 7%, the difference between 7% and say 9% would be 2%, and that 2% of excess earnings is credited against your existing unfunded liability balance. So this sort of works vice versa to how new UALs are created. They can be eroded, and they can come down in a similar way to when they go up based on overperformance by CalPERS investments. The UAL, moving down to the fourth section of the page, the UAL is an obligation of the town or of the police authority that's similar to other long-term liabilities that would appear on your balance sheet. They have a principal and an interest component and are charged that 7% interest every year. And in terms of the investment community, such as investors or rating agencies, it's effectively looked at as debt, even though it doesn't directly appear on your balance sheet like a lease or a general obligation bond would. Beyond that, the main difference between a UAL, which we're going to refer to as a soft obligation, and a hard obligation, such as a lease or a general obligation bond or a revenue bond, is that it is in fact a soft obligation and not a hard obligation. And that main difference is for a soft obligation like the UAL, if you are late making your payment, or you only make a partial payment, or if in a certain fiscal year you decide not to make a payment at all, you're not going to have a trustee and bondholders knocking at your door trying to remedy the situation right away and in a quite serious matter. CalPERS is willing to work with you. They'll give you a new amortization schedule and help you re-amortize that obligation and accept a partial payment in a given year, so that they're willing to work with you. This is something that we always like to point out right away. These hard obligations, which a pension obligation bond that we're going to get to shortly would fall under, there are trade-offs involved. So the trade-off in this standpoint is once you refinance this obligation at CalPERS with private investors, they're not going to be as flexible with you. So we just like to point that out from the start. Any questions on slide 4?
I'd interrupt or mention that the transition from a soft obligation to a hard obligation, in our view, that is the primary negative that is involved with this kind of transaction. Otherwise, the numbers, as you will see, the numbers are pretty compelling toward the in a positive manner toward the transaction. The moving from a soft to a hard obligation is a negative, but if you are financially able and willing and determined to make your payments, it really doesn't make a difference whether it's a soft payment or a soft obligation or a hard obligation. You're going to make it either way. So, but it is a distinction that we want to make sure that you're aware of.
Okay, I have a question, Rob, if I can.
Mm-hmm.
This is Stanley. Over the last 5 to 10 years, just as a sample, how often has CalPERS overperformed? Have they exceeded their expected rate?
I don't have the numbers in front of me, but they do exceed 7% in some years, maybe on average, probably 2 or 3 years out of every 10 years. So they're not overperforming in the sense that you can take your huge unfunded liability and count on CalPERS investment performance to bring that down to 0. But they do average about 6.5 to 7% over a period of years for their investment return. So they are relatively close over a period of time to that 7% target return.
I have a question.
Mhm.
If you're done, Stanley, are you done?
Yes, go ahead.
Oh, okay. So I had a question regarding that as well. Is that 7% target that CalPERS has, is that realistic? I mean, you're saying it averages about 6.5. Why don't they plan on a lower number?
Well, they have been lowering that number over time. So I believe it started out back when this program started closer to 8.5%. And then over time, they've gradually been bringing that number down to 7%. So I believe last year it was at 7.25%, and 2 years before that it was at 7.5%. So they are realizing that maybe their initial target return is a little bit too rich, and they reserve the right to lower that target return to a lower number in the future. Although they have not announced that they're going to lower it beyond 7% to this point.
How long has it been around? How many years?
Mark, you may be able to answer this one better than I.
I can't.
How many years has the? Oh, I'm sorry.
It's been around a long time. I would say probably 30, 40 years, something like that.
Oh, okay. Okay.
It's well established, and as Rob said, it's the largest retirement program in the country.
Right.
One of the problems that they've incurred is that they have a long-term horizon as far as their investments go, which is a good approach. But taking that on, they've done a lot of investments in real estate and in fixed income like treasuries and bonds that have a fixed rate of return. And if they've got 60-70% of their investments in those fixed rate return securities or transactions, when the stock market goes up, they are able to participate, but only maybe 30% of the portfolio is impacted by it. The rest of it's on a given track. And as a result, they even though the stock market may do well, they tend to underperform. But those long-term investments, though, they're committed and they're not as liquid where they can get out of them. In fact, they may be underwater on some of them as a result of the last real estate recession. So, you know, they buy shopping centers, they buy all kinds of things. They're huge. They need to be able to have a diversified portfolio, but that it has its benefits, but it also has its drawbacks.
I'll just pipe in really quick that they began in 1932, so they're 88 years old, CalPERS.
Wow.
And Mark, can I ask a question? I got some information at some other point in another presentation through a school board around CalPERS as well, because school are also following CalPERS. I'm a school employee. I'm on CalPERS myself. That CalPERS had done really bad investment about 10, 15 years ago, and we are still paying the price for that. How accurate is that? Is it really like the crisis of the real estate back 12 years ago is getting so much of a bad hit that CalPERS could not recover? Is it what we are facing?
Well, they've got their gurus in Sacramento that you know are supposedly experts in investments and portfolio management, much like a mutual fund would be, or that sort of thing. And I'm sure they get all kinds of opportunities presented to them, and they would take it to their, much like we're doing here, they would take it to their committees, evaluate the pros and cons, and then they would take it to the overall board and decide, yes, this is something that we want to do, or no, we don't want to do that. But they, again, as I say, they have a long-term perspective.
Mm-hmm.
And that's one of the problems in my view of the stock market. A lot of investors there want their return tomorrow or within a month, and they don't look down the road long-term like Berkshire Hathaway. They look on a long-term perspective, and that's turned out very well for Berkshire. But here, I guess CalPERS invested in some investments such as real estate when real estate was hot and doing really, really well. And then they got caught. And so once you lose money, it's really hard to dig yourself out of that hole. And it's a long-term process. It will recover, it will come back. But in the meantime, the portfolio suffers. So I don't know if that answers your question or not.
Well, thank you. Yes, this was my understanding as well. It just helps, adding one and one together. Thank you.
So with that, Rob, you want to continue on to the next slide?
I will. Okay, moving on to slide 5. There are 3 main solutions to fund your unfunded liability at CalPERS. And in the following slides, we'll be expanding on the 3rd solution that's listed here. So the first solution is to continue to pay CalPERS based on your existing 20-year amortization or payment schedule, or other shorter term schedules that CalPERS offers and provides that are outlined every year in their actuarial valuation reports that are sent to the town. The second solution is to just pay off your unfunded liability, either in whole or in part, with surplus funds of the town or of the authority. Now in 2020 and in the age of COVID-19, we found that not a ton of public agencies just have a lot of excess funds laying around that they'd like to pay to CalPERS. So this situation or this solution isn't always available to everyone. You can also participate in different pension trust reserves. The Section 115 Trust Reserve is probably the most popular of those programs. And the third solution that we're going to be focusing on in the second half of our presentation is to pay off the unfunded liability in whole or in part using proceeds from the issuance of a pension obligation bond, either in the form of a lease revenue bond or as a general fund secured obligation. So if the authority or if the town issues a pension obligation bond to fund your unfunded liability at CalPERS, your unfunded liability balance will be paid down to 0 or paid down to whatever amount is ultimately chosen. And if the current unfunded liability is paid in full, future CalPERS investment performance will determine whether or not additional UAL is created in the future. Should CalPERS fail to achieve their projected rate of return, even after you've issued a bond and paid your unfunded liability down to 0, that future shortfall in investment performance will create a new UAL. Conversely, should CalPERS achieve higher than expected returns in the circumstance where you issued a pension obligation bond to pay that off, and there's no unfunded liability to sort of be credited against by CalPERS overperformance, that excess sits as a credit in your unfunded liability account to offset any future unfunded liabilities that may be created. You can't withdraw those funds or do anything with it, but it does sit there for your benefit and will be there for future unfunded liabilities.
Yeah, I might interrupt that the current UAL balance, which is around $8 million, has been accumulated over a number of years at the town. And that's a function of CalPERS' lack of meeting their objective. So they every year that they don't perform, the UAL grows. And the next year they don't perform, the UAL grows. So you've accumulated a corpus of about $8 million now. If that $8 million were to be paid off with a pension obligation bond, should CalPERS underperform, say, the year following payoff of the UAL, the new UAL would be much, much smaller because it would be only the amount of 1 year's accumulation. It would not be over whatever length of time you've taken to get the current status. So it would be a much more manageable amount, and you could potentially use some savings or whatever to be able to pay that UAL, that new UAL down or off, so that you don't get into a position of accumulating a larger balance again. Sorry, Rob, go ahead.
Yeah, no, thank you, Mark. And really, this third bullet point here is to be abundantly clear to everyone that we talk to about these sort of programs, that paying off your unfunded liability in no way eliminates the potential for future unfunded liabilities to accrue or be created. The only way to take that risk completely off the table is to exit the CalPERS system entirely. Really what a pension obligation bond is, when you sort of bring it down to brass tacks, is it's really an interest rate play. You're trying to take that interest rate of 7% that they're charging you every year on that outstanding liability and lower it to a more reasonable rate with a private investor, typically in the range of 3 to 4 to 4.5%. And it's really a play on interest rate savings. Is there any questions to this point? Please.
Sorry, I have a question. So because rates are so low right now in general, is that why this is a good time to do this?
That's exactly why this is a good time to do this. Interest rates hit all-time lows in August, and they've remained historically low since that time. Only, I believe we're up about 30 or 40 basis points from the all-time lows. And that's really why you've seen a big flurry of these in the market in the last couple of years. Even a year and a half or 2 years ago, when rates weren't as low as they are now, but they were really low and lower than they had been in a period of years, you really started to see these hit the market because it really is just this interest rate play. So once interest rates got low enough, it made all the sense in the world to most entities and organizations to transfer this obligation to private investors.
And based
Yeah.
on
How difficult? Oh, I'm sorry. Go ahead.
based on current interest rates, you would be going from the 7% cost of funds and that CalPERS is charging you. And we estimate that you'll be, in today's market, if the market doesn't change a lot, you'd be cutting that in half to about 3.5%. So there's a wide margin as far as the differential in interest rate that you'd be incurring.
That makes total sense. My only other question is, these investors who are buying the bonds, is it difficult to find them? Is this something that everybody out there is clamoring for right now? How hard is it to sell these?
Well, we go through a process of, we did this with Larkspur, the city of Larkspur. We did it with Fairfax. We did it with Belvedere. We did it with a sanitary district, Richardson Bay Sanitary District. Those are just local ones here. There are a number of others that have done it in the state, but those are just recent ones that are just very, very local here. There's just been a lot of interest in going this direction because the numbers are pretty compelling, as you'll see later on in the presentation.
No, I understand that. What I'm wondering is, who is it exactly that is buying the bond?
Well,
It's insurance companies, it's commercial banks, it's retail investors. There's a lot of demand for securities of this type right now.
Okay, that was my question. Thank you.
what we
And
do-
really
Very,
a
very
lot of
long
it-
term. I was thinking like corporate investors, right? It's not people like us who are buying that, right? It's part of another tool by some major investors.
Yeah, we go
Yeah.
through, what we do and what our current direction is with the CMPA
Mhm.
is we sort of keep our cards close to our vest. We would evaluate whether a private placement would be more advantageous or a public offering.
Mhm.
In the case of Larkspur, we went through a process where we did a competitive RFP to select an underwriter or a placement agent. And we had not at that time made the decision whether to do a private placement or underwriter yet, or a public offering. So once we got closer, we go through a process, and once we get closer to being able to issue the bonds, that at that point in time, then we made the decision in Larkspur's case to do a public offering. And so the underwriter then goes out and markets the bonds to institutional investors as well as retail investors. And it's up to the underwriter to find the investors. But if I'm not mistaken, Larkspur the timing was just really, really good. By the way, they got a AAA rating, and it was noteworthy that the rating agency Standard & Poor's said that they viewed Larkspur to be even stronger credit than the United States government, which was kind of an interesting point. But nevertheless, those bonds were sold at an interest rate that I don't believe, I'm unaware of any other pension obligation bond that's been sold in California that had a lower interest rate than they did. So, and that was done, what, in February or March, wasn't it, Rob?
I believe it closed in May.
Okay, yeah.
And do we have any idea how the town of San Anselmo or the CPMC is rated?
I'm proud to say that the town has the same rating as Larkspur.
Woohoo!
Oh, I
Right,
have a
right,
question.
Ellen?
Yes, yes. Mhm.
So now would this interest rate be locked in for the full term of the bond, the 20 years?
That's correct. Yes, it will not change.
So is another way of, or basically what you're saying is that the CalPERS target rate of return would have to drop to less than the 3.5% or whatever it is for this to have been a bad decision on our part? Is that correct?
I think so. And if they were to go down to, say, 3.5% on CalPERS expectations, that would take probably decades to get there. And then in the meantime, you would be continuing to pay whatever rate they are charging. So the differential between what the rate they're charging and the POB rate would be additional payments that you would be making.
Right. Okay. So that's a pretty unlikely occurrence.
Unless something, something that we are totally unaware of, CalPERS to change its entire bookkeeping system and investments program. But it's so big, it's like trying to turn a battleship. You can't just do it. It takes a long time to get it to move.
It's a dinosaur, yeah.
And there's a lot of politics involved also, unfortunately.
No, I think what Richard is alluding to is that if there is, for instance, a 20% correction in the market and CalPERS is losing money, they're not going to lower their rate of return, like you say, immediately, but they're just going to up the UAL for all of the members.
Exactly.
Yeah, so we just start accruing new UAL.
Something has to give. And what it is typically has been is they just charge you more to cover the shortfall.
The UAL is a great investment for CalPERS because all members will pay them essentially a guaranteed 7% return every year. They don't have to go and find the investments and make money that way. It's at least not as much.
So you want to continue then, Rob? Go ahead.
I'll continue. So this brings us to the second portion of our presentation, which is the financial illustration of the town of San Anselmo's safety police plans at CalPERS. So the Central Marin Police Authority administers 2 retirement plans at CalPERS on behalf of the town of San Anselmo. The town safety police first tier plan and the town safety police second tier plan. The first tier plan has a UAL balance right now of $7,910,000. The safety police second tier plan has an approximate UAL balance of $161,000, totaling just over $8 million between those 2 plans. And these numbers are taken from the latest CalPERS actuarial valuation report that was published in July of 2020 and is based on the last audited figures, which are as of June 30th, 2019.
They're always a little bit behind the curve as far as their audits and so forth, but
So these two plans and obligations have a payment schedule, and the full payment schedule is listed on the following page. The payment for the coming fiscal year on these two plans are shown right here. For the Safety Police first tier plan, the payment scheduled for next year is $733,000. And the payment scheduled on the second tier plan is just over $14,000, totaling just under $750,000 for next year. And looking at slide 9, you can see in fiscal year 2021, 2022, that balance persists, and the town is on a approximately level payment plan.
But this shows in the first column, it shows the safety first amortization schedule. The next column shows the second tier amortization, and then the last column is the combined payments for those two plans.
So each year, CalPERS refreshes this amortization schedule, and it'll either increase or it'll decrease based on their performance from the prior year.
So these payments are not fixed. This is just the way they would amortize the current balance. But if that balance grows, the payments will grow as well.
So jumping to slide 10, this is what a pension obligation bond, this is what we project a pension obligation bond would look like for your Safety Police plans at CalPERS.
This is your portion. If you were to participate in the CMPA, this is what your portion would look like.
So the par amount of bonds, or the amount of money to be borrowed, we've projected at $8,245,000. And the uses of the money borrowed would be as below. Just over $8 million would be paid to CalPERS to fund those unfunded balances. And the rest, which we've projected roughly to be approximately $173,000, would go to pay the underwriter and the underwriter's discount, as well as the cost of issuance, which contains all the other fees, attorney fees, printing fees, etc. And these are conservative ballpark estimates for sake of this analysis.
And I might point out that if you were to do this alone, not as a member of CMPA, those fees would be higher because it would be a standalone. If you're doing on the coattails of CMPA, you get a buy down, you get a lower, reduced cost overall.
Moving ahead to slide 11, this is an example debt service schedule that we would project for the town's portion should it participate in the CMPA's issuance. In the far left-hand column where you see principal, this would be the principal payback schedule over a period of 20 years. The next column over shows the interest rate schedule, and we've projected this bond offering to be sold as a public offering for this analysis. In a public offering, each maturity or each year has its own interest rate that's set, and then different investors can buy bonds for a certain year or a certain maturity. And together these blend to create a weighted average interest rate, which in the case of this illustration is approximately 3.40% or 340.
Rob, is that what they call the quote unquote true interest rate?
That's right. The
Okay,
TIC.
great. Thank you.
You've seen this before.
Yeah, I saw it in the Larkspur report. They had that. I wasn't quite sure if that's what. Thank you.
What the TIC is the present value of the interest cost, and it includes all the costs of issuance when you get the all-in TIC. So you have the backing up where we had the cost of issuance, the underwriter and the cost of issuance, that sort of thing. That plus the interest cost, and then the present value of that's where you get the true interest cost.
I see, compared to the net proceeds.
Correct.
Okay.
So this amortization schedule equates to total payments over a 20-year period of just over $11 million. And the payments are structured to be level each year. So it'd be approximately $580,000 a year in payments. Moving down to our final slide, slide 12. This is the projected cash flow savings analysis, and all savings shown on this table are net of all financing fees, all charges, all expenses. So this would be this jumping to the end here, this $3,326,000 figure would be the cash flow savings to the town for those two plans, net of all costs. Just below that at the bottom of the page, we show the net present value of this stream of cash flow, which when discounted at the TIC or true interest cost that we just discussed, produces net present value savings of $2,416,000.
So that's the savings in today's dollars. And
So-
you might note that the average savings there looks like it's about 174,000 per year.
Right, and for purposes of this illustration, we structured the pension obligation bond as a 19-year obligation when compared to the 20-year UAL obligation of CalPERS, and that's predominantly due to just this final CalPERS payment being quite small, and the added expense and difficulty of selling just a small amount of bonds in a particular maturity. So this would be the projected payment schedule compared to the CalPERS schedule, producing approximately $173,000 of savings each year for the town relative to those two plans.
And Rob, is the CMPA amortization schedule, does that conclude in 3940 also, same year?
No, for what we've modeled so far, the CMPA schedule goes out that 20th year and is mature in fiscal year 2040, 2041.
Okay.
But that's just a structuring nuance that'll be worked out down the road.
Right.
Question? Am I up?
Yep. Yep.
You said that if the town chooses to ride the coattails of the CMPA, they would have a bit of a discount on the underwriting cost and the cost of issuance. What would be the difference if the town decided to finance this bond independently and not ride on the coattails? Just for comparison's sake, what's the difference?
Well, it would be a smaller issue. And so your fixed costs become a larger portion relative to the size of the transaction. If this is combined with the CMPA, we would be having anywhere from a $27 to $30 million total transaction. So as a function of that, the costs are lower on a per bond basis than they would be if it was a smaller transaction, because the cost of issuance are more or less fixed. And so you don't get the economy of scale and I to give you an actual dollar difference, I don't know that I can do that. We could do some analysis that way, but all I can say with assurance is that your costs of issuance are lower on a combined basis because it's spread over a much larger base.
Yeah, I don't need an actual dollar amount, but are we talking about a 25% premium, a 50% premium? What are we talking about?
I think I can provide some context here, Mark. We've done pension obligation bonds for other communities in amounts similar to $8 million, and those fees usually came out at the end between $200,000 and $300,000.
So is that the conclusion of what you got to share?
That's the conclusion of the slideshow. I think it's just question and answers now.
Well, I'd like to interject here. We meet with the CMPA board or council tomorrow night, where they will be authorizing moving forward and adopting or approving the trust agreement and authorizing proceeding with the validation proceedings. However, bond counsel does not want to initiate the validation proceedings until such time as we know whether San Anselmo is in or out. And that will not happen until next month when your council, should you decide to take it to council, I don't want to be presumptuous, But if you do decide to take it to council, your council, then if San Anselmo Town Council decides, yes, you do want to participate, then we would have the go-ahead to be able to initiate the validation proceedings on behalf of CMPA, and everything would go in concert as one package deal. And that process of validation, bond counsel draws up all the legal documents. What is basically is an amicus brief at the court, where you're basically suing yourself, saying, we're doing this, but the city attorney says, no, you can't do this. I want to have verification from the court to say that this is in fact legal. And the court has, to our knowledge, has never acquiesced, that because it is what they want to do is they want to get a confirmation that it's a government imposed obligation on another government entity, and that has an exemption to it where you do not have to have an election. So that's all that's being tested. And once we get that validation affirmation from the court, then we're able to be able to move forward with the marketing of the bonds and that sort of thing. We would come back to CMPA council to get them to authorize or accept and approve the preliminary official statement, the marketing document, disclosure documents, that sort of stuff. So the only thing that's left to do after we conclude the validation process is the sale process of the bonds. But the validation process can take anywhere from a month, maybe a little over a month, to 3 months. And that's a function of the courts. And we don't really know, we don't have control over that. It depends on their backlog and their prioritization of their agenda.
I have a question.
Mm-hmm.
And this actually is more, well, it's a broader thing. Broader look at it. What is the total amount that the CMPA is trying to turn into bonds, of which we are 8 million of it?
If you participate, it would be a minimum of $27 million. You would be about 8 of that. And the reason we say as much as 30 million is once we get approval and we get to the very end of the process, what we do is we check in with CalPERS to get an update as to what your most recent UAL balance is. And typically that's a little bit higher than what we're showing here. And so what we do is we integrate that into the transaction. So we have an allowance of 30, I think, or 31 million with CMPA. So we don't have to go back and increase the amount after the fact. So we we build in a little wiggle room there for an increase by CalPERS.
Are all the members of the CMPA part of this, or going to be part of this?
Yeah, the members are Corte Madera and Larkspur and San Anselmo. And so,
okay, so those two have already said yes, they want to do it.
they're all in, yes.
Right, okay.
And
That was my question. When did they review that? Recently, or that has been going on for a long time? Because like it all came quite quickly, and I was just trying to understand how that came so quickly for us to make that decision. Is it because we didn't realize we were we had that option early, or did we just didn't? Yeah. Why are we so late in having that conversation when you are actually when the commission is voting about it tomorrow?
Well,
I can try and answer that, Mark, and you can fill in the blanks.
Okay.
So the CMPA holds 2 different UALs, as you know, the one that's was in existence and carries the prior authority, Twin Cities, along with the last 7 years of the current authority. And then they were moving forward to refinance that. They didn't have the ability to, because ours sits with us, it is really our responsibility to try and do the bonding. When they started the process back in the fall, Helen and I got involved and said, we'd love to see about taking advantage of the savings with our piece as well. So we met with Wolf Hansen and Mark and kind of came on board late. We weren't initially considered in the initial issuance, but after we saw what the benefits were, that we've kind of been working towards this and have gotten enough information to actually join in the bond if it all works, but with the permission of CMPA. So that's kind of how it just came on that we joined later. We were already the bigger pot was already on track to be refinanced with a bond. And that was just because that sits with the CMPA and is under control of the CMPA. We just wanted to take advantage of it. Initially, the San Anselmo piece wasn't going to be considered.
To Dave and Helen's credit, they sort of saw an opportunity that was happening with CMPA, and they said, aha, maybe our UAL would fit in there. Could we do that? And so we talked, and then we had to talk with bond counsel to find out whether or not it was doable, or if you had to do it separately. And bond counsel found a way that we could do it as a meshed deal. And
Yeah.
so the combined savings to the CMPA, when you add your 174,000 to theirs, ends up being about $534,000 per year. That's over $500,000 a year. That is money that's freed up in their budget, and they can use that can be applied toward OPEB retirement challenges that you be faced with. It can be done with it. It's general fund money. So the council will have discretion on how to deploy that. So it's a significant savings relative to the overall budget. So that's the reason that Larkspur and Corte Madera are moving on it.
Okay, so another question then. This UAL R8 million, is it strictly a UAL from the police before we joined CPMC?
Yeah.
Okay, and it's strictly police. It doesn't have anything to do with staff or any of the PERS on that.
No, when the consolidation included moving all the safety obligations over to the new authority. So this
So
is
you
just for the prior safety piece, which for CalPERS purposes, they separate those out.
Okay, that's why there's tier 1 and tier 2.
Yeah.
Okay, and does the town of San Anselmo have any other UAL with CalPERS besides this?
We do. We have the town's UAL, which is not, this is not something we're considering right now. It's a little bit of a different animal, but we're certainly going to be exploring that as well.
Okay, and so that's not something that could be thrown in with the CPMA.
No, the Central Marin UAL they're already paying, just to reiterate, they're already paying the San Anselmo piece. That's part of the deal, but the San Anselmo UAL is part of the obligation of the CMPA and has been since the merger, since the consolidation. So San Anselmo, of course, pays a portion of that as part of our contribution every year to the CMPA, but it really is a chunk of the larger UAL. Because of how it's set up as being a San Anselmo obligation, initially wasn't part of the consideration for the issuance of bonds. And like we mentioned back a month or so ago, the managers have been looking for ways to deal with, the large, unfunded debt. And this was because Larkspur and Corte Madera had already done bonding for their, individual UALs. They thought it was with the interest rate, a good time to do it with CMPA. And then Helen and I said, we should see how we can squeeze this one in there too, because it's a savings for everyone if we do. And we're able to get there.
And a question about something that you had said earlier, Dave. You said it was on our books, even though it shouldn't have been. So showing on our books is the UAL as well as how much we give to the authority on a regular basis?
No, I guess I need to define on our books, and Helen, you can step in anytime. It's in the eyes of CalPERS, it's San Anselmo's safety UAL.
Okay.
In the execution of the annual payment, it's a CMPA liability, and it has been. So, but for a number of reasons that they're kind of hard to explain, that the safety wasn't moved and merged with the Twin Cities UAL. What happened was the Twin Cities and the new CMPA, or Twin Cities moved into the new CMPA because they were the prior agency, and that's how we've continued. And this other one has, for all intents and purposes, it's part of the CMPA's liability. You know, it's part of the budget. You know, we don't pay anything separate. We pay our contribution, which includes the annual lump sum payment, but mechanically it's still sitting under the town's auspices. And this is a way to kind of put it all back together.
Gotcha.
Yeah.
Thank you.
I might make a couple of other comments. It needs to be really clear that CMPA is only paying on the obligation of the police safety plans,
Yes.
not on the miscellaneous.
Right.
The town is paying on the miscellaneous UAL and obligations. The other thing is that if you do participate in this transaction with CMPA, you will be moving the UAL obligation that is now on the town. You will be moving that obligation to the CMPA. So you'll be taking an $8 million liability off of the town's books and putting it on the CMPA books, which is also, I think Helen, it was, she was smiling when she.
Yeah, that's definitely appealing, right? Yeah.
Yeah.
Mark, did you guys talk about if a possibility to consolidate, for future unfunded liability to the CMPA or not yet?
Well, the miscellaneous program that is unique to the town itself is something that we are not, we can't give advice on something unless we've been retained to do advice, because there are certain regulatory requirements that we have to go through, and we have to provide you with disclosures and fees and all that sort of stuff before we can give you advice. However, and subject to staff's inclination, we can visit that, but we need to wait and get this police safety program underway, and so that there's a clear distinction between one transaction and another. And if the town should decide to retain our services to be advisors to the town of San Anselmo, then we can advise you and work with you on the miscellaneous. But right now we can't mix apples with oranges, because we're going to get in trouble with the regulators if we do that. We can't give advice to the town as the town. We can only give advice to the town as a member of CMPA, and that pertains only to the police safety plans.
Right. My question is regarding the piece, right now currently in town's liability for safety piece. Once we paid off, future we have potentially have more new unfunded liability incurred. Will this be consolidated? Once we paid off, consolidate together, then and the new unfunded liability going to become part of CMPA liability instead of still.
So it would still be on the CMPA's books, not on the town of San Anselmo's books.
Because it would still be part of the safety UAL.
Yeah, it will under the current arrangement with CalPERS, it will, I'm assuming that it will remain an obligation of the town. Any new UAL.
The new one, the new one we will still, we will build it on our books, but it will be 1 year at a time, right?
Right.
Okay.
And it'll be much smaller, and with $500,000 savings per year, it's possible that CMPA may be able to pay off any new UAL as it comes on board. And so it would be exhausted as it comes on. But we don't know. That's the future. We don't know what's going to happen there. But my understanding, having talked with the CMPA attorney, who I've known for a long time, because we were involved in doing the new police facility and financing that and all sorts of other things. But my understanding, the reason that your CalPERS obligations have been held back and have not been merged into CMPA totally is because CalPERS got burned in the past when there were members joined a joint powers authority. And once they did that, they stopped making contributions to the JPA, and the JPA defaulted on the payments to CalPERS, and CalPERS said, we don't want to have that happen again. So they didn't allow San Anselmo to completely merge their plan into CMPA. However, once the UAL is paid off, should you decide to go ahead, once that UAL is paid off, I think it gives CMPA and the town of San Anselmo more ammunition to go back to CalPERS and say, look, we, in good faith, we paid this off. You don't have exposure anymore, except for future UAL going forward. So why don't you let us completely merge our plans into CMPA? I think it gives you a much better position to renegotiate with CalPERS on that note, and it's possible that they may accept it. But the reason that it was not allowed to merge is because they have had problems in the past. It was nothing about San Anselmo or the Twin Cities Police. It's just that CalPERS had a bad taste in their mouth from previous experiences.
We could try that again.
Question.
I just wanted to jump in because it's timely. Along those lines, there is a section in the amended joint powers agreement, which is what CMPA is constructed under, that the decision for issuance of any bonds requires a unanimous vote of the full police council. And section 4.4 also provides that any member benefiting from the bonds may not withdraw from the authority until the bonds have been paid off or adequate provisions for such repayments have been made. So that's a further commitment that we'll be able to show to CalPERS that we're in this.
Exactly. Right.
So I just have a question on slide 5. You presented that this bond issuance that we're talking about can either be a lease revenue bond or a general fund secured obligation. I just want to be clear which one it is that you are proposing.
Well, we showed that to the police council, and the direction was that, and we could have used the police facility as a leased asset to lease and lease back and fund it that way. But both Todd and none of the managers or the chief, none of them wanted to go there. They would rather do this validation process, and it doesn't tie up any assets that way. And it leaves that asset free and clear. Should you want to do a transaction in the future, you'd have the availability of that asset. But it was unanimous between Dan, Todd, and David and the chief that they wanted to only consider the validation process.
Which is the general fund obligation.
That's correct. And so that's the direction we're going.
And you think that there's probably not going to be a problem with getting the amicus brief taken care of so that it doesn't have to go to a vote?
No, I mean, the law, there are exemptions. There's a lease exemption where you don't have to have a vote. There's a governmentally imposed obligation on another agency, which is another exemption. And there's another one, I don't remember what it is, but all we do is we go to the court and have it validated that, yes, the court says this is a properly, legally, governmentally imposed obligation on CMPA and the town. And then once we do that, we're bulletproof. Nobody can challenge it.
That's great.
And it makes it easier to market the bonds that way too, because nobody can be worried about, oh, what happens 5 years from now? Somebody raises that problem. It's water over the dam.
Dave,
Yep.
do you foresee any problems in making any of these payments since we'd be going from a soft to a hard obligation?
No, this, like I say, this continues to be just part of our regular contribution as a member of the CMPA. So it's sort of embedded in how that formula works out. We each pay a third of the annual UAL, and that's including what's there under the town now and what's under there with the UAL from the authority itself. So that the only change will be we'll be paying less at this point. So, you know, we're fully committed members of the agency, and you know, this will, like I say, the one thing we hope to do actually is to not just take this money and spend it on something else, actually put it into something like an OPEB or deal with another financial issue. So the savings will be really, really helpful for a lot of reasons.
Dave, and isn't it also true we've just paid off, or maybe it's this year, a previous pension obligation bond, and I think the payments were around 500,000, and you know that would be money that would otherwise go into the general fund, but in some sense we're kind of continuing that stream of payments. So, and I don't know if they've been committed in.
I think do those end in 2021, Helen?
Yeah, we have one more year. This year we only pay $200,000. The dollar amount drop, but I think we, based on our 5-year forecasting, that will be committed for operation need. It's not, you know, yeah. I think each town have their own financial situation. You know, we do have our challenges, special for our cash flow. But I think this opportunity is good for us, at least testing out, at least try something new and then diversify our risk. Hopefully we can get a benefit of this and then see if this worked for our remaining the unfunded liability as kind of guinea pig test run for us and see how it goes. Yeah.
Right. And I had one more question, Dave. Would we, you mentioned a few possible uses of the savings. I'm not sure you mentioned putting it into the trust, pension trust that we set up. Is that another option we could do?
I think that's probably our first option, Richard, is because then we could use it for any of our pension liabilities. So, you know, we haven't worked out all those details yet, but we'll probably recommend that to council that be added to what we're already doing. We're putting small amounts into the pension trust each year. This would allow for a larger payment, and those grow pretty fast, especially the way the market is. We're able to invest them a little bit more. They're still super conservative, but compared to, you know, where they would have been, it's under LAIF, it's a much better deal for us.
Okay.
So
Great.
what do you need from us?
Well, we wanted you to fully understand what this step could look like, and we were hoping that you would could maybe come up with a recommendation. We're going to council, as I mentioned, on the 12th. We're doing the police council tomorrow night, and then we need the approval of the town council to be able to move forward. And you know, it's kind of great that we have, although this was rushed, like Marie said, we would have liked to have more time to study, but it just is, it's pretty clear that it's going to be a win-win for everyone. So we really wanted to, as we said, as we've had these meetings over the fall to kind of get you guys up to speed, this is exactly what we want the Financial Advisory Committee to be doing, is kind of taking a hard look at this stuff and making a recommendation to council, who has the final authority to act. So tonight would be basically a motion one way or another, and a vote.
Okay, so Marie.
I don't know if Ford has anything to add. I know he's been listening, but he's pretty up on it. He heard this whole presentation.
No, I'm way up on it now.
Yeah. Well, we heard this presentation for the other piece of the UAL in November, and that's what sort of spurred us to want to get San Anselmo's portion involved, and we're pleased that that's hopefully going to work out. But we do need to bring it to council and have Ford's third bite at the apple on this information at the meeting on the 12th of January.
Well, it's a really great technique, and it's the savings are really stellar. So I'm very much in support of this.
Great.
Marie,
I have a question.
yeah.
If I could, please.
I'm sorry.
I have a question for Helen.
Cool.
Right now, the town has a little over $6 million in outstanding bonds. Is that true?
That's
Overall.
That's all. Our original issuance is our pension obligation bond. Right now, as of last year, June 30, we have 438. So we have one more payment. We're done.
I'm just looking at what's the ballpark indebtedness of the town going to be if we take on $8 million debt as a percentage of our budget? Are we at the debt to revenue ratio over 100%?
So actually this debt is not town's debt. It will be CMPA debt.
Yes. It would not be on the town. It would be on CMPA. And that's what I mentioned before. You're taking this town obligation and you're shifting it, moving it over to CMPA. You're getting it off your books.
But in reality, the CMPA has been paying it since 2013. It's just it's where it sits in CalPERS eyes.
Right.
That's the tricky part. Yeah,
And the town still pays a portion towards that though.
exactly right. As part of our annual payment to the,
So are you asking Stanley how much that is going to be in addition to what we're doing now? Or are you thinking that it's part of what we would already be doing, right? Or we are already doing?
Mhm.
So the
well,
money, not going to be more money that we're going to,
yeah, to reframe it right now, I don't know exactly how much, but we're going to be, CMPA is going to be paying about $534,000 less every year towards its UAL payment as compared to what we're paying now directly to CalPERS and what we'll be paying to pay the debt service on the bond. So there's actually a savings there. It's a demonstrable savings. So this really doesn't change anything as far as the town's debt. It does take, technically that 8 million and move it into a bond with CMPA. So, but it really is a shell game in that respect because we haven't been paying it. We've been paying it as part of our normal payment to CMPA.
right. So, but would those payments be lower? Because it'd be, when we wouldn't be paying it 7%, we'd be paying it 3.5 or
Yeah.
4.
Exactly. Yeah.
That's bottom
500
line. That's what it is, right? In the end. Yeah.
Savings.
So
Yeah.
we're 38% of the CMPA budget. We're the biggest, organization in there. So we're going to get 38% of the savings of this 534,000.
Yeah.
Although actually this one's split 3 ways. This is actually, we're all going to be saving,
Instead of
$185,000 a year, 180. So it's a good deal.
Yeah.
So the debt is going to be, the bond is going to be issued by the CMPA.
Correct.
It's not going to be owned by the town. So what is the risk to the town's ratepayers, taxpayers, though, if we don't pay the interest payment and the bondholders come seeking their money? I mean, I'm just worst case scenario.
They would go to CMPA.
So there's no risk to the
Well,
property owners of San Anselmo in this?
no, the risk would be to CMPA and its participating members as members of the JPA. But that's a general fund commitment that, as Dave was saying, that each of the members, and including San Anselmo, are committed to participating in the JPA.
So eventually, yeah, if the JPA went under, then the town could be affected.
Ultimately, it's our
Yeah.
liability.
You might
one way or
dissolve,
another.
you might dissolve the JPA or whatever, go your own
Yeah.
separate ways. But again, you're dealing with high grade members. I mean, you're AAA on San Anselmo, you're AAA with Larkspur. Corte Madera, I don't think is quite at the AAA category. They're a little bit lower than that because of some of the stuff that they did in the past. But you're dealing with high grade entities that,
Partners.
I just don't perceive a risk there.
Well, and quite frankly, if we couldn't pay that, we couldn't pay CalPERS either. So they'd be coming after somebody.
Yeah.
Right, but it's the soft versus the hard obligation that was discussed.
That's true.
CalPERS will
That's true.
negotiate, the bondholders will not.
Right.
Right. But that's why we only try out for this piece. We now
Yeah.
consider town as a whole because we still have fire piece, we still have miscellaneous. So we do want to take an opportunity, this interest savings, try out because technically the police one is only 1/3 our obligation, right? So, if working out, a financial cash flow, everything work out, then maybe we can consider moving the other stuff forward. But right now we just try out and take advantage of the market as well. So.
Yeah, you don't put all your eggs in that basket. You put a
Right.
third of your egg in that basket, lock it for lower, lock it,
Yeah.
and then we hope for the best, right? It's
Exactly.
okay. In my own
Great
101 for
question,
dummies.
Stanley. Yeah, great question, Stanley.
Yeah,
I
that's a
appreciate
good one.
Okay.
Is it the time where we vote, or do we have any more questions? And do we have any? Yeah, Laurie has a question.
No question. I was going to make a motion if
Yes.
there aren't any more
Laurie
questions.
was ready to move to the motion. No,
Sorry.
I can see.
There's
Anybody else?
nobody here. There's no public attendees.
I
So
was going to ask, nobody from the public joined us? No public comments, so now is it time to
Now
propose a motion?
Okay, I'd like to make a motion that we go ahead and tell the CP, or go ahead with the bond obligation with the CPMA.
I
CFPA,
second.
sorry.
And we're just so we're recommending the council that we do that. So
Yes.
just-
Correct.
Yeah.
Thank you.
Great.
And I second. All in favor? So
Will
let
you
me
do-
make sure I have everybody, let me write the name here. Richard? Yes.
Aye.
Stanley?
Yes.
Eric?
Yes.
And Marie, of course, yes. And me, Marie, yes. You have everybody, Carla? We're good.
I think that's-
Thank you, everybody, once again for making time tonight, and thank you to Mark and Rob for a great presentation.
Fantastic.
Yeah, we'll move forward to the having a presentation at the, as I mentioned, January 12th meeting with your recommendation included in the staff report. So everybody have a great holiday season. I know things are very different this year, but it's nice to see you all at least on Zoom.
Thank you.
Okay.
Thank
Happy
you.
You
holidays, everyone.
take
Yeah.
care, everybody. Thank you so much, Rob and Mark. Thank you.
Bye.
Thank you.
You.
And
Bye-bye.
Bye-bye.
Dave and